The world did not end with a bang. It ended with a blank screen. On a Tuesday morning in October, people woke up to find the global stock market had simply stopped. The tickers were empty. The flashing green and red arrows were gone. The numbers that dictate so much of our modern world had vanished. All major stock exchanges would be closed for 30 days. Not for a holiday, not for a technical glitch, but as a deliberate, coordinated decision. The reason was not immediately given. There was only the silence, and the sudden cold realization that a fundamental part of our lives had been put on pause. This was not a story of computers failing, or a system breaking down under its own weight. This was a choice. Regulators, central bankers, the heads of the largest financial institutions, had met in secret. They had agreed to pull the emergency brake. They told the public this was a necessary measure to ensure stability. They promised to reopen in exactly 1 month. The message was broadcast globally, translated into dozens of languages. But its core simplicity left more questions than answers. It was a shock to the system, a deliberate halt that sent a tremor of confusion through every home. In the first hour, the global financial system began to test its own boundaries. The complex web of automated systems that execute millions of trades per second simply went dormant. Large investment banks, the giants that act as the market's plumbing, stopped matching buy orders, sell orders for equities. Market makers had no prices to offer. This meant that anyone holding stocks, a multi-billion-dollar pension fund, an individual with a small retirement account, could not sell them for cash. The value of their holdings was officially frozen in time, a number on a screen with no real-world meaning until the market reopened. Brokers were immediately inundated with calls. Financial advisors were immediately inundated with calls. Their messages to clients were filled with careful, legally approved language about an unprecedented market event. Some clients reacted with anger and fear, demanding access to their money. Others were surprisingly quiet, paralyzed by the sheer strangeness of the situation. A few, particularly older investors who remembered a time before digital trading, simply called their children their parents, seeking a human connection in a moment of digital disconnection. The personal, emotional side of money was suddenly laid bare, stripped of its usual jargon and complexity. Within that first hour, the pressure began to radiate outward to other parts of the financial world. Hedge funds were operating on borrowed money. Large investment firms were operating on borrowed money. With the value of those stocks now officially unknowable, lenders grew nervous. They couldn't price the risk they were holding. Some began making calls to review the terms of these loans. Others hesitated to extend new credit. This created an immediate cash squeeze for leveraged firms, forcing them to sell other assets, like bonds, currencies that were still trading. Meanwhile, the retail investing boom, fueled by easy-to-use smartphone apps, hit a solid brick wall. Millions of ordinary people who had become accustomed to buying shares with a simple tap, selling shares with a simple tap, were suddenly locked out. A wave of panic selling was averted simply because it was impossible. Some tried to place buy orders, hoping to catch a bargain when the market eventually reopened. Many others began transferring any uninvested cash from their brokerage accounts into traditional bank savings accounts. Banks noticed this small but significant spike in transfers, a quiet flight to the perceived safety of simple, accessible cash. The world held its breath, waiting to see what would happen next. As the first day bled into the second, the true interconnectedness of the financial system became starkly clear. The halt was no longer just a problem traders, investors, it began to affect the mechanics of everyday payments, business operations. Some companies use short-term money market funds, which can hold commercial paper backed by corporate assets, to manage their daily cash flow. With the stock market closed, the valuation of some of these assets became uncertain, causing a slight tightening in the credit markets. Payments that were normally instant and seamless suddenly required extra checks and verifications, a small friction that slowed the velocity of money. The issue of liquidity became paramount. Liquidity is the lifeblood of an economy, the ability to convert an asset into cash quickly. With the stock market frozen, everyone began to hoard cash. Companies delayed non-essential payments. Banks became more cautious about lending to each other. Central banks around the world immediately convened emergency meetings, managing inflation, ensuring the banking system did not seize up. They needed to prevent the stock market pause from triggering a full-blown credit crisis, where even healthy businesses could not get the loans needed to pay their staff suppliers. For the average person, the first 48 hours were a period of watchful waiting. People checked their online banking apps more frequently. Use of ATMs saw a noticeable uptick in major cities, not out of widespread panic, but from a quiet, instinctual need for the tangible security of physical cash. The news was a constant loop of experts offering theories. Was this a test? A drill? Was it a response to a threat so large that the public couldn't be told the full truth? The lack of a clear, detailed explanation from authorities was a double-edged sword. It prevented mass panic, but it also fueled a low-grade anxiety that simmered just beneath the surface of daily life. On the second day, a sense of eerie calm began to settle in some quarters. With no market to watch, the relentless pressure lifted from corporate executives. Some saw it as a forced holiday, a moment to step back and think about long-term strategy, without the tyranny of the daily ticker. However, this calm was not shared by all. Small business owners, especially those seeking new investment or relying on lines of credit, felt a growing unease. Their futures were tied to the confidence of lenders' investors. That confidence was now a giant, unanswerable question mark. The world had split into two camps: those who could afford to wait, those who could not. After the initial shock subsided, the deeper effects of the month-long freeze began to ripple through the real economy. The stock market is more than just a casino for speculation. It is a primary mechanism for companies to raise capital. Firms planning to sell new shares to fund expansion, to build a new factory, to launch a new product line, to hire hundreds of new employees, had to put those plans on hold indefinitely. The pipeline for initial public offerings completely dried up. The flow of fresh investment capital into the most dynamic sectors was choked off at its source. This capital freeze had a direct impact on employment and growth. It did not come from a leak or an investigative journalist, but from an official, coordinated announcement by the G7 finance ministers. The market closure, they explained, was not just a defensive measure to prevent a crash. It was a deliberate, offensive move to implement radical reforms on the core infrastructure of the global financial system. The pause was being used as a window of opportunity to rewrite rules that had been debated for years, but were always blocked by powerful vested interests. The reforms were sweeping and audacious. They included new, stringent limits on high-frequency trading, the practice of using powerful computers to make millions of trades in fractions of a second. The goal was to reduce market volatility, driven by algorithms rather than human judgment. They also introduced a global circuit breaker standard, rules that would automatically halt trading in a more controlled way during extreme stress. They announced new transparency requirements for complex derivatives and for shadow banking entities, parts of finance that operated outside public view and had been implicated in past crises. This revelation completely changed the narrative. The pause was no longer seen as a mysterious, frightening event, but as a bold, almost revolutionary act of governance. For millions who felt the system was rigged, this was a moment of vindication. It felt like governments were reasserting control over a system that had grown too powerful and complex. The news was met with a surge of public support. Hashtags of panic on social media were replaced with hashtags of approval. It was a political masterstroke, turning a potential disaster into decisive leadership. However, the reaction within the financial industry was sharply divided. Some leaders publicly supported the reforms, many others were furious. They saw it as a massive overreach of government power, an arbitrary changing of the rules in the middle of the game. They argued changes, implemented without proper consultation, would stifle innovation, reduce liquidity, and ultimately harm investors. For them, the pause shifted from a technical problem into an ideological battle. It was a fight for the soul of modern capitalism, happening while the market itself was closed. Away from the grand pronouncements of governments and the strategic maneuvers of banks, the month-long pause settled into the lives of ordinary people in myriad ways. For the vast majority whose jobs were not directly tied to finance, daily life continued with a surprising degree of normality. The sun still rose. Buses still ran on time. Grocery store shelves remained stocked. This continuity provided a powerful, grounding sense of reassurance. The world, it turned out, could keep turning without the constant hum of the stock ticker. However, for those working within or adjacent to the financial industry, the uncertainty was a heavy burden. The pause brought a halt to deals, commissions, bonuses. A mortgage broker saw her pipeline drying up. A junior analyst now faced the prospect of a cancelled bonus. Some firms put staff on reduced hours or mandated unpaid leave. The emotional toll was significant. Many checked their online retirement accounts daily, only to be met with the same static number. Values as of market close on October 28th. That frozen number became a symbol of their suspended future. While checks continued, they worried about the long-term health of their savings. Would the market crash when it reopened? Would their nest egg be permanently damaged? These were questions no one could answer. Yet, amid the stress, there were moments of calm. With the pressure to monitor markets removed, people found they had more time. There was a collective global exhale. Many began to question society's obsession with the market. As the financial world adapted to the temporary stasis, a subtle but powerful wave of innovation began to emerge from the shadows. The crisis acted as intense selective pressure, forcing new ways to solve old problems. Fintech startups, peer-to-peer platforms, and supply chain financing surged. They created simple ways for small businesses to get liquidity by securitizing future invoices and physical inventory. This was the second major reveal of the month, less dramatic, perhaps more profound in the long run. The freeze accelerated a shift away from centralized, traditional institutions. People and firms discovered they could move money, manage risk, and secure funding without relying on the constantly churning stock market. Some funds pioneered new cash-like instruments backed by diverse pools of short-term government and corporate debt. Communities experimented with local currencies and barter. A bakery might trade bread with a farmer for wheat. Finance proved to be a network of networks. When one pathway was blocked, others formed. A seed was planted. The tools built during the pause did not disappear. They continued to grow, offering an alternative ecosystem alongside the traditional one. On the final day of the pause, a palpable tension gripped the globe. In financial centers, traders returned before dawn. Newsrooms readied their cameras. Tokyo, London, New York. The world was about to witness a unique experiment. What happens when a month's worth of economic data, corporate news, geopolitical events? Everyone knew the opening would be volatile, but no one knew which way the tide would turn. As the opening bell finally rang, the silence was shattered by a torrent of activity. The first few minutes were a chaotic flood of buy orders, sell orders. Prices for some stocks leaped dramatically. Positive earnings and breakthroughs were rewarded instantly. Other stocks plummeted. Weak data and newly risky sectors were punished severely. The volatility was extreme, with some stock prices swinging by 10–20% in minutes. Regulators and central banks watched with bated breath. New circuit breakers were tested, and brief halts gave the market a moment to breathe. Unlimited liquidity kept the plumbing from clogging. The opening was violent, but not disorderly. The system bent, but did not break. Then came the final twist. As chaos subsided, a strange pattern emerged. The market as a whole was not crashing, nor soaring. It traded almost exactly where it left off. Huge gains in some sectors were offset by losses in others. The pause, reforms, and innovation had all been priced in. In its collective wisdom or madness, the market concluded that after all the drama, nothing had fundamentally changed. The value of the world's enterprise was, for the moment, the same as before. In the weeks and months that followed the reopening, the world slowly adjusted to the new normal. Daily trading resumed its familiar rhythm, and the frantic headlines faded. The stock market had survived its induced coma. Yet some changes proved permanent. New rules curbing high-speed trading remained, leading to a market slightly less volatile, and for some, a little more fair. Lenders, reminded of fragility, adopted a more cautious approach to leverage, making the system incrementally safer. The economic and social consequences were a mixed ledger. Economists would debate the net effect for years. Some argued it prevented a devastating crash, saving pensions and savings. Others contended it slowed investment, delayed growth, and harmed small businesses and financial workers. The truth was somewhere in between. A high-stakes gamble that paid off, not without leaving scars. The most lasting lesson was philosophical. The market, for all its power, was a human construct, a tool that could be turned on and off. The economy was not the market. For 1 month, the world distinguished the abstract world of finance from the real world of jobs, homes, communities. This realization lingered, fostering skepticism toward daily market pronouncements and greater appreciation for tangible economic life. The pause gave people perspective. And so, life went on. But the memory of the month the money froze remained. The world learned it could survive a financial heart attack. It learned leaders could act with bold, decisive unity. But the strangest legacy, the market reopened exactly where it had closed. It left a lingering, bizarre question in the minds of all who lived through it. Did the market truly reflect the real world, or was it just reflecting itself? An endless loop paused for a moment, only to resume its inscrutable game. You've been watching IfVerse, where imagination meets possibility. See you in the next reality.